According to some bloggers in social media, Dubai real estate market has collapsed by at least 17% in just 1 week.
Dubai's DFM Real Estate Index has fallen by 20% in the last 7 days. Clearly indicates that buyers are not buying and sellers are withdrawing all my money.
So this is the Burj Khalifa and this is the DFM Real Estate Index. DFM is basically a Dubai Financial Market Real Estate Index which tracks the movement of property prices there.
Some even claim that the decline could reach 30 or even 50%. That sounds dramatic, doesn't it? In reality, many cash investors started immediately hunting distressed deals -30 to -50% below the market. But what is actually happening? Because when you look closely at the data, the real data, the story becomes much more complex. And in this video, I will break down where this 17% crash narrative comes from, why it is misleading, is the market really full of distressed deals, what the real market indicators are showing, and what investors should actually watch right now. Let's go. The claim that Dubai property prices have dropped by at least 17% usually comes from financial market charts, especially stock market indices that track the shares of major developers and real estate companies. Well, when geopolitical tension rises, financial markets often react immediately. Investor sentiment changes quickly, stocks fall, and in recent days, developers' shares in regional markets have indeed moved downward. So what is happening now? The DFM Real Estate Index has fallen by approximately 20%. The biggest declines were seen in Emaar and Deyaar developers. Possible reasons include geopolitical risk in the region, profit taken after a strong market rally, concerns about potential overheating in the property market. But there is a critical problem with using these charts to describe the real estate market, because stocks are not property prices, guys. Developers' share prices reflect expected future profits, financing costs, global investor sentiment, and geopolitical risks. But it does not directly correlate with the price of apartments or villas being sold in the city. So as we all know, stock market can reprice in minutes while real estate cannot. Despite this particular example, which is a pure manipulation because stock market doesn't reflect the off-plan market prices and totally ignores the secondary market behavior, however, we should look at this index at a different angle. There is a historical observation that developer stock often move before property prices. This happens because financial markets react much faster to changes in expectations. Investors in stock market constantly try to anticipate future supply, financing conditions, interest rates, global capital flows, and geopolitical risks, as I said before. As a result, developer shares often start declining months before actual property prices begin to adjust. And by the way, if we look at Dubai's previous cycles, we can see a similar pattern. Let's look at 2008 financial crisis. Before the major property crash in Dubai, during the global financial crisis of 2008, developer shares had already started falling earlier. Financial markets reacted quickly to tightening credit conditions and global risk sentiment. Property prices, however, took longer to adjust. The actual correction in housing prices unfolded over the following months and years, not instantly. The next example is oil shock cycle that happened back in 2015. Similar dynamic appeared during the 2014-2015 oil price shock. As oil prices collapsed and regional liquidity tightened, developers' shares declined first. Property prices in Dubai began adjusted later. The demand from regional investors softened, and that continued all the way until September 2020. With exception of COVID, of course, that even boosted the downward cycle. Again, financial markets reacted earlier than the physical property market. Next phase, pandemic shock of 2020. During the COVID shock, probably many of you remember, financial markets reacted immediately. Developer stocks dropped sharply in the early months of the pandemic as investors feared a collapse in global travel, tourism, and real estate demand. But property prices did not fall overnight. The adjustment in the real estate market occurred gradually over the following quarters. What this pattern suggests, this is important to understand because it highlights a key difference between financial markets and property markets. Stocks reflect expectations about the future. Real estate prices reflect actual transactions happening today. And because property transactions take time, obviously, to negotiate, finance, and close, the real estate market tends to move much more slowly. Why this matters for the current narrative? So when we see volatility in developer stocks today, it doesn't automatically mean that property prices have already collapsed. Most probably it may indicate that financial markets are adjusting expectations about the future cycles. But the physical property market will respond, if it does, much more gradually. Again, unlike financial markets, real estate transactions take time. A typical property sale in Dubai involves several stages: negotiation between buyer and seller, signing the memorandum of understanding or Form F, mortgage approval if financing is involved, final transfer at the Dubai Land Department. From agreement to registration, this process often takes 2 to 6 weeks, sometimes even longer, which again means that property prices do not move day by day like stocks. The transactions that we're looking at today were locked up way earlier. Even during major global crises, housing markets usually adjust gradually. And this is why claims of 17 and so on % decline in a single week immediately raised many questions, because property markets simply do not behave this way. What about the volume? Let's look at what the actual transaction data tells us. Dubai typically records thousands of property transactions every week. If the first week of March, the Dubai Land Department registered several thousand sales worth billions of dirhams in transactions value, that means that even during a period of geopolitical tension, the market continued to process thousands of property deals. Now, it's important to acknowledge something. Many of those transactions were negotiated earlier. But this still tells us something important. Because if investors truly believed that the market was about to collapse by 20, 30, or even 50%, we would likely see a different behavior. Buyers would start walking away from the deals, transfers would be postponed, transaction volumes would freeze. As per now, we don't see this kind of market paralysis. At the same time, in conversations with investors and property owners, there is no sign of widespread panic in the market. Many investors continue to follow their original strategies. They want to sell their assets, they want to lock in profits, or simply rebalance in their portfolios. And this is an important point, because if the market truly expected an immediate drop of tens of percent, the behavior of the market participants would likely look very different. Despite receiving numerous inquiries from the potential buyers hoping to purchase properties mostly in prime areas, at prices at least 20% below the market, there is no evidence of mass wave of sellers rushing to exit the market. Property markets are ultimately markets of expectations. When investors believe that the prices will fall sharply, several things usually happen. Buyers step back, they wait, they postpone decisions. At the same time, sellers may rush to exit the market. The number of listings increases, inventory rises. Only after these dynamics begin to build, prices start adjusting. But these processes typically unfold over months, not days, because real estate markets don't crash overnight. Let's think about what we actually may be seeing in the future. None of the above means that the market cannot change. Real estate cycles exist. And especially Dubai's property market has always been cyclical. After several years of strong growth, it is natural for investors to start asking questions. Is the market approaching a turning point? Is supply increasing? Are incentives becoming more aggressive? These are the kinds of indicators analysts usually watch when trying to understand where we are in the cycle. But these signals develop gradually. So when you hear claims that Dubai real estate has already collapsed by 17% or more in a single week, it's important to ask a simple question. What data is that actually based on? Stock market charts or real property transactions? Because real estate is not a financial market. However, there is a much more interesting question emerging right now. Not whether or not the market crashed last week, but where we actually are in the property cycle. In the next video, we will look at the late cycle signals that analysts usually watch in real estate markets, including developer incentives, supply pipelines, and shifts in investor behavior, because those indicators may tell us far more about the future of Dubai's property market than a viral chart on social media. Thank you for watching, share your thoughts in the comments, subscribe for more value, and see you in the next video.